Welcome to this explainer. Today, we're diving straight into BYD's latest investor briefing to unpack a massive and honestly fascinating valuation paradox. We're looking at a company that is absolutely crushing operational records, yet the stock market seems to be telling a completely different story. It's a real mystery of scale, strategy, and market sentiment, and we're going to break it all down for you right now.
17 million. Yep, that's not a typo. In July 2026, BYD officially produced its 17 millionth new energy vehicle, a Seal 08, rolling right off the line at its Xi'an plant. I really want you to let that number sink in for a second, because it represents an unprecedented scale that is completely unmatched by literally any other automaker in the new energy vehicle segment. They aren't just participating in the EV transition, they're producing at a volume that is historically redefining automotive manufacturing. So with all this insane momentum, it begs the million-dollar question, right? Does all this massive operational strength actually translate into shareholder value? Because as we'll see, building millions of cars is one thing, but getting Wall Street to accurately value that massive machine is another challenge entirely.
To figure this out, here's our agenda for today. We're going to look at the valuation paradox itself, the unprecedented scale and financials, the strategic technology roadmap, Wall Street's reaction, and finally, the risks and a huge upcoming catalyst. All right, let's jump straight into Section 1, the valuation paradox, growth versus stock price. To really grasp this disconnect, you gotta understand the sheer financial gravity of this company. BYD recently shot up to number 91 on the 2026 Fortune Global 500 list. We are talking about a 2025 annual revenue of approximately $111 billion US. And the kicker? They aren't just burning cash to grow. They pulled in a very solid net profit of roughly $4.5 billion US. These aren't just vanity metrics, folks. This is a highly profitable juggernaut operating in one of the most fiercely competitive sectors on Earth. Moving on to Section 2, unprecedented scale and financials, specifically looking at their performance in the first half of 2026. Okay, so moving 1.8 million total units in just half a year is staggering in itself. But the makeup of those sales is where it gets really interesting. Take their exports, for example, nearly 790,000 units. That is a massive 68% jump year over year. Exports now make up roughly 44% of their total production volume. This tells us that BYD is no longer just a Chinese domestic heavyweight. International markets have become a fundamental pillar of their high-margin business model. Which brings us to Section 3, the strategic technology roadmap, or, as I like to call it, building an empire.
You know, range anxiety and long charging times are basically the twin bottlenecks for EV adoption everywhere, right? Well, BYD's answer is a 1-2 punch. Their second-generation Blade battery paired with incredibly fast 9-minute flash charging. But technology is practically useless without infrastructure, so they're rolling out 26,000 of these flash charging stations globally by the end of 2027. And they aren't going at it alone. They've partnered up with Sinopec to leverage existing fuel station footprints for a rapid, aggressive rollout. They're building the whole ecosystem, not just the car.
And they're also tackling autonomous driving, but they're doing it by democratizing the technology. They offer their LiDAR-equipped God's Eye system as an option across all models for just 12,000 RMB. To prove they actually believe in their own tech, BYD became the first automaker to offer a 1-year safety liability guarantee for its City Navigation Assist feature. This effectively turns advanced autonomous driving from a high-end luxury feature into a mass-market competitive advantage. Now, add in a global partnership where they're the official automotive partner of Paris Saint-Germain, hello, massive global brand visibility, plus a strategic MOU with Buscat BHD for an electric bus assembly plant in Malaysia. When you put it all together, you see a really cohesive, multi-pronged strategy: technology leadership, global infrastructure, brand elevation, and strategic regional manufacturing. All right, let's get into the mystery in Section 4, Wall Street and the divergence, focusing on the Q2 rebound. So how is Wall Street actually modeling all of this? Well, BYD did have a somewhat softer first quarter, but Morgan Stanley is forecasting a massive rebound for Q2. They're projecting that per-vehicle profit is going to jump significantly from 5,700 RMB in Q1 to an estimated 7,600 RMB in Q2. That is a highly profitable recovery curve, to say the least. And this recovery is perfectly reflected in the analyst consensus. The major institutions are largely super bullish here. Citibank has a strong buy rating with a target of 142 Hong Kong dollars. Morgan Stanley rates it overweight with a 121 target, and CMBI says buy at 125. Analysts are seeing the improving fundamentals, the high-margin export growth, and they believe this Q2 earnings recovery will really clear up any concerns about second-half visibility. But here is the ultimate paradox. As of late August 2026, the stock is sitting at 91.25 Hong Kong dollars. That's down over 24% from its 52-week high. So why the slump? Well, Citibank attributes this divergence not to the company's actual performance, but to external noise. Capital has been flowing heavily into AI funds, and there's a lot of negative sentiment surrounding international tariffs. So the fundamentals are improving, but the stock has been sinking. This leads us perfectly into Section 5, Risks and Upcoming Catalysts Looking Ahead. Of course, there is a bear case here, driving some of that market hesitation. Analysts point to four main risks. First, intense domestic price wars in China are constantly putting pressure on profit margins. Second, tariffs and protectionist trade barriers in key global markets could definitely threaten that incredible 68% export growth we talked about. Third, there's just sheer execution risk. Building 26,000 charging stations globally is a monumental task. And finally, some models just flag near-term valuation concerns, despite the recent stock pullback.
But here's the thing. All this speculation is about to collide with reality. We know about the 1.8 million units in H1. We celebrated the 17 millionth vehicle in July. But the immediate catalyst to either confirm this massive recovery thesis or totally challenge it is tomorrow, August 28th, when BYD officially drops its Q2 results. That single data point is going to either validate the analysts' high price targets or confirm the market's current anxiety.
So, as we wrap up this explainer, I want to leave you with something to really think about. BYD has proven, without a doubt, that it is a vertically integrated powerhouse with unmatched scale. But will that operational growth and tech edge actually outpace market expectations and the hurdles of a really complex, protectionist global trade environment? The numbers tomorrow will give us our first real clue. Thanks for tuning into this explainer. We will definitely be watching closely.